Hello my fellow investors and welcome back to another earnings report video as well as stock analysis video. Now I'm actually going to do this video guys on the company Amgen. You guys already know because you pretty much just clicked on the video. But the reason why I'm actually doing this company today is because I recently found out something interesting about it. And the fact of the matter is that it has fallen down a lot. But more specifically, it has fallen down to a very, very unique price target for me. So I really would like to take a look at it again. So with that said, let's get started with this analysis. So obviously, based off of that initial statement, y'all can infer that I do own this company. And, here it is. I actually do own this company in my portfolio. I own around 31 shares worth of this company. And we can see that the current price, guys, is around $223.42. Now, the reason why I'm actually very, very interested in this company is because, well, my average share price, it is $221.82. So we are essentially very, very close to my price tag to when I originally bought this company, at least for my average share price. And on top of that, if we actually take a look at the graph, guys, we can see on the 52-week range that they are near 52-week lows. So not only has it reached the price that I originally bought it at, but it's also a 52-week low company, which is a great opportunity to take a look into this company and see if maybe I would like to buy more or has things changed since my original purchase. And seeing that this thing went as high as $296, guys, again, this may present itself as a great buying opportunity once again. But before moving on into their earnings report and their fundamentals and doing a discounted free cash flow approach, guys, I really do need to point out something very, very important when it comes to any and all pharmaceutical companies. And that is that you really have to take a look into their pipeline. Right? This is a major problem, especially when it comes to pharma companies because, well, majority of a company's revenue, at least pharma companies' revenue, comes from the drugs that they provide, right? The drugs that they sell. However, though, in the United States, after a certain period after this drug has been in the market, the patent expires and it gives leeway for generics to come into the market. And that usually is a little bit cheaper than the original brand, which then would cause people to go for the generic brand rather than the original one. So in that kind of scenario, the company's revenue from that initial drug may take a dip. We actually saw this in regards to AbbVie, right? AbbVie, their Humira drug went off market, I believe, last year. And, well, that's now the problem that they have lost a decent amount of revenue. And the same principles applies to that of Amgen. So I'm going to leave this in the description below. You can see all of this company's drugs that they have upcoming and what phase they are in as well. So, take a look at these, see what you can learn from them, and see what kind of determination you can come up with in regards to their future profits. You can see that they do have a lot of drugs in their phase 3 already, but most drugs, again, most drugs don't make it to the final endpoint of phase 3. So again, this will be linked in the description below if you guys would like to read it for yourselves, but keep that in mind when it comes to any pharmaceutical company. So with that said, let's jump into their earnings summary. They had earnings on April 27th. EPS normalized actual came in at $3.98, beat by 13 cents. EPS gap actual $5.28. That was a beat by $2.32. Revenue $6.11 billion, which was a miss by $72.05 million. Really nice, guys. This is exactly what I kind of want to see because, I mean, they are beating when it comes to their earnings. However, their revenue did miss. And as a result of that, well, the stock price is essentially falling, which is a great thing for us value investors. So let's come now into their first quarter financial results. We got, quote, we delivered 14% volume growth driven by the breadths, by the breadths of our portfolio and strong demand for our products globally, said Robert A. Bradway, Chairman and Chief Executive Officer. We look forward to closing the acquisition of Horizon Therapeutics and joining forces to reach more patients around the world with their innovative medicines. However, guys, this acquisition that Amgen's trying to make to buy out Horizon Therapeutics is actually getting a massive blockade due to the FTC suing to block the pharmaceutical giant Amgen from acquiring Horizon Therapeutics, saying that it would entrench monopoly drugs used to treat 2 serious illnesses. So the FTC is really coming after them, and they're like, we're going to stop you. Like, they're suing in order to stop it. However, I think this may have caused the drop in Amgen to begin with. So that is something really interesting that's happening, because at the same time, well, this was as of May 16th. So this earnings report that we got was on April 27th. Obviously, when this was written, they didn't think that things were going to be this rough when trying to acquire Horizon Therapeutics. However, there's also some pretty good, I guess, upside in regards to this acquisition. The Amgen deal with Horizon is likely to go through despite FTC objection. This is from Guggenheim. So we got over here the Federal Trade Commission's lawsuit seeking to block Amgen's acquisition of Horizon Therapeutics will be unsuccessful given the high bar the agency is up against, according to Guggenheim. The analyst Michael Schmidt said that while the FTC's actions provides a heightened risk of regulatory scrutiny from emboldened regulators willing to test novel theories of antitrust harm, the agency's arguments would need to align with how courts have recently ruled in cases regarding the antitrust concerns, and recent precedents don't bode well for the FTC. However, he noted additionally regulatory scrutiny could become more common, and with Amgen and Horizon, it could delay the acquisition from going through by 6 to 12 months. Quote, we expect the lawsuit to be closely watched as a bellwether for future potential legal challenges to biopharma M&A, including which anti-competitive theories of harm will be pursued by regulators. Example, pursuit of patent thickets, bundling and rebate practices with PBMs, etc., Schmidt wrote. So you have one side where obviously the FTC is trying to stop this, bringing in the antitrust lawsuit against them. However, at the same time, if courts have recently upheld or I guess followed a different kind of way to determine these kind of antitrust rules, things may actually go through and Amgen may acquire Horizon Therapeutics. However, after this kind of situation all happening, guys, Horizon did plunge, and by the way, this was as of May 16th, Horizon plunges as FTC lawsuit increases risk to Amgen deal. So yeah, this may be the main reason as to why Amgen has fallen down this much, but it may actually serve guys as a great buying opportunities, as I originally said. But this is pretty much the development of this whole entire acquisition when buying Horizon Therapeutics with Amgen, as the CEO just mentioned here. All right, so let's move on into their key results when looking into their earnings. We got over here, total revenues decreased 2% to $6.1 billion in comparison for the first quarter of 2022, resulting from lower other revenue from our COVID-19 manufacturing collaboration, partially offset by a 2% increase in production sales. Product sales growth has driven by 14% volume, wow, partially offset by 5% lower than net selling price, 3% unfavorable changes to estimated sales deductions, 2% lower inventory sales, and 2% negative impact from foreign exchange. Excluding the 2% negative impact of foreign exchange in the product sales, total revenues were largely unchanged from Q1 of 2022. So pretty much, guys, what they just said here is just like, yeah, COVID stuff is kind of dialing down a little bit. We're seeing a pretty big drop here. Aside from that, it really is just not really different from what we have seen before in the past, so it's nothing too bad, honestly. Now, looking further into here, we can see that volume growth of 14%, including double-digit volume growth from Evenity, which, by the way, these are all their drugs. We got Blincyto, Nplate, Lumacras, sure, Amgevitas, okay, Amgevita, sure, Repatha, and Kyprolis and Vectibix all had an impact on this 14% growth. And then ex-US volume grew 22%, including 47% growth in the Asia Pacific region. Coming over here to the third bullet, we can see the company generated $0.7 billion of free cash flow for the first quarter of 2023 versus the $2 billion for the first quarter of 2022. That's a massive change, guys, in regards to the free cash flow. That's absolutely insane. What a drop. Driven by the timing of payments for sales incentives, rebates, and discounts, lowering operating income, and higher capital expenditures from building out our new North Carolina and Ohio facilities. So there you go. They actually tell us as to why their free cash flow actually went down. You can see, again, higher capital expenditures. Okay, that makes sense, right? That makes sense. Free cash flow is cash from operations, less your capital expenditures. Also, the fact that The timing of payments for sales incentives, rebates, and discounts also affected that, and lowering operating income. So that's the reason why. Scrolling down further, we can see the amount of millions of dollars that each one of these drugs actually made in the US, and I'm assuming that this is the world, and of course the total, Q1 2022 total, and then the change for the year over year. There's a lot of these drugs, guys. You guys can read it for yourselves, but as you can see, when it comes to total product sales, year over year, it was an increase of 2%. Scrolling down even further, we can take a look at now the operating cash flow, capital expenditures, and the free cash flow, as well as even the dividends paid. So we got over here operating cash flow. It was Q1 of 2022, $2.2 billion. Q1 of 2023, $1.1 billion. That is a decrease of $1.1 billion. Capital expenditures, $0.2 billion came up to $0.3 billion. That is an increase of $0.2 billion, which I'm assuming that this is just rounding error. Free cash flow went from $2 billion down to $0.7 billion. That's a decrease of $1.3 billion. Dividends paid, 1.1 to 1.1. That is, again, probably rounding error. $0.1 billion increase. Share repurchases has pretty much not changed at all. And average share dilution in millions, it is 551 to 538 million shares. So very, very nice to see. That is a decrease of 13 million shares. And unfortunately, it's actually interesting of how they do it, because they even tell us, guys, their debt outstanding and their cash and investments as well. December 31st, 2022, they had $9.3 billion in cash and investment, whereas in March 31st, 2023, $31.6 billion in cash and investments. That's a net change of $22.3 billion. Debt outstanding has gone up, going from almost $39 billion to $61.6 billion. That's an increase of $22.7 billion. And continuing on, we can see that they have the 2023 guidance excludes any contributions from the announced acquisition of Horizon Therapeutics. The company expects the announced acquisition of Horizon Therapeutics to close for the first half of 2023. However, as I just showed you guys, Amgen's actually not planning to close on the Horizon deal before September 15th in court agreement with the FTC. So I don't believe that this is going to happen for the first half of 2023, since they're going to wait till September. For the full 2023 year, excluding any contributions from the announced acquisition of Horizons, the company expects total revenues in the range of $26.2 billion to $27.3 billion. On GAAP basis, EPS on a range of $15.38 to $16.56, and on a non-GAAP basis, from a range of $17.60 to $18.70. Capital expenditures approximately $925 million, and share repurchases not to exceed $500 million. And they even go on to tell us the update on this pipeline, as I just showed you at the beginning of the video. We got over here general medicine, Olpasiran. Okay, cool. Olpasiran, whatever it is. AMG 890, a phase 3 cardiovascular outcome study of that word, a small interfering RNA molecule that reduces LP synthesis in the liver, and participants with cardiovascular disease and elevated lipoproteins continues to enroll. So they're just pretty much, guys, going to give us an update on all of these drugs. That's one of them. We also got AMG 130, phase 2 study of AMG 130, a multi-specific molecule that inhibits the gastric inhibitory polypeptide receptor, oh my god, and activates the glucagon-like peptide receptor and in overweight or obese adults with or without type 2 diabetes. Mellitus continues to enroll. And we got a bunch of other ones, guys. So again, this will be all linked in the description below so you guys can read it for yourselves. So we just went over a lot when it came to this company, and well, let's see what this kind of free cash flow actually tells us. So we're gonna go through this rather quickly. We got the ticker for AMGN, market cap of $119.4 billion and a PE of 15.18. So with this PE, guys, and the current share price of $223.42, again, as I showed in the beginning, this might be a very decent buy, seeing that this company is at 52-week lows. They do pay out a dividend, which is one of the reasons why I like this company, $8.52. Now, this dividend is a yield of almost 4%, to be exact, 3.81%. payout ratio of 45.64 with a 5-year CAGR of 10.5%, a dividend growth years of 11 consecutive years. Ex-dividend date passed, however, unfortunately, as of May 17th. Payout date will be on June 8th, and they pay their dividends quarterly. Looking at how many shares outstanding they have, and this $8.52 in annual dividends, we could calculate that they dish out, guys, $4.55 billion in dividends every single year. After this is paid in regards to their 5-year average free cash flow, they're left with $4.7 billion in their 5-year average free cash flow, and unfortunately $4.23 in their last year's free cash flow. These payout ratios are 52% for the last year's free cash flow and 49.33% for the 5-year average. It is really, really disheartening to see the fact that their last year's free cash flow, it is slightly lower, but we just read, guys, they are planning to, make an acquisition, right? That's still going to go through. They are making more facilities in Ohio and all this stuff. So this free cash flow may go down a lot more, but at least we know the reasons as to why. So it has its pros and cons, right? It has its pros and cons. So let's go on now into their fundamentals. And starting, of course, with the net income, well, this one is actually decreasing, going from $8.4 billion to $6.55 billion, decrease of 22%. We can see here that pretty consistently decreasing from 5 to 2 years ago, but as of 1 year ago, this did bring it up a little bit. Overall, guys, I'm going to give this a 40%. Looking now into the free cash flow, this one is very, I'm not going to say consistently decreasing, but definitely somewhat decreasing, I guess you could say. 5 years ago of $10.56 billion to 1 year ago of $8.78 billion, decrease of 17% with an average of $9.23 billion. Now, I'm actually going to give this, guys, a 75%. And here's the reason why. They have told us as to where this free cash flow is going, right? Where the capital expenditures is actually going into, which in turn, they're even saying, yeah, we're going to have lower free cash flow. Like, this is the reason why. We're not hiding it. Is because, we're building new facilities. We're making this acquisition. So expect lower free cash flow. Okay, if that's the case, then, well, the way that I see it is, at least they aren't, I guess you could say, at least we know where this is going, right? At least we know where this is going. So that's why I'm giving it a 75%. Looking now into the revenue. Revenue is actually going up pretty nicely. $23.75 billion to 1 year ago of $26.3 billion. That is an increase of almost 11%. I'm going to give this, guys, a 95% as a grade. Really, really nice, consistently increasing, or at least almost consistently increasing. Assets minus liabilities. This one, however, does not look too good. You can see a very, very downtrending graph, and only as of 1 year ago is when they brought it up from $3.66 billion to $5.35 billion. So that's going down. Now that they're, well, let's see if they do it. If they purchase Horizon Therapeutics, not only are they going to take their assets, but they're also going to take on their debt as well. So yeah, I don't know how that's going to affect this. Average total assets, it is $67.5 billion. Average liabilities, it is $60.57 billion. Doing this difference, we get almost $7 billion. Because I don't know where this might go, I'm going to give this a 50%. Looking now into the cash flow minus the liabilities. Obviously, we can see that the cash flow has been decreasing, but as of recently, it's been going up. But obviously, as I said, we may see it go down even further. You can see here, they have had instances, only one instance of it going slightly higher, but overall, it's still a downtrending graph. Average cash flow minus the average total liabilities, it is negative $45.45 billion. I'm going to give this, guys, a 30%, mainly because there isn't major outliers, right? There isn't any major outliers. It's somewhat retained at around like the $40 billion mark. Only as of 1 year ago, it's gone down to negative $52.68 billion. And that's the reason why I'm giving it a 30%. Now, what is looking amazing is this shares outstanding. Take a look at this. 5 years ago of 629.6 million shares to today of 534.3 million shares. Decrease of 15.14% on the 5 year, and a very, very, very small increase of 0.06% from the previous year to the current year. Overall, guys, you can clearly see, I mean, this thing is just super consistent, massive buybacks overall. I understand that there was a slight increase from 1 year ago to today. So you know what? I'm actually going to lower this 100% to, I would say, like a 98%. All right, mainly because that was tiny increase. it's still an increase, so I'm going to have to give it a slightly lower grade. And lastly, when it comes to the cash equivalents, they currently hold $31.56 billion with an average of $11.07 billion. So when it comes into the overall grades, we gave the net income of 40%, free cash flow 75%, revenue 95%, assets minus liabilities 50%, cash flow minus liabilities 30%, shares outstanding of 98%, overall grade of 68%. So yeah, this is a case that, once again, guys, please do not follow what I am doing, right? Because I bought this company and I plan to continue to buy this company, even though my grade I gave it is 68%. I have my reasons as to why I buy this company, even though it is under the 70% mark, right? So that's the reason why, guys, every single time in every single video, I'm always saying, please do your own due diligence. This is not due diligence. Every investment is the present value of all future cash flow, and this is not financial advice. So with that said, 68%, is this a good price to buy this company at? So now let's come into the discounted free cash flow. Putting in a required rate of return of 10%, we can see that, well, unfortunately, the prices are about $100, right, for both, adjusting for debt and not adjusting for debt. Highly doubt whatever number I put in here, this thing will go up to $223. So looking at Seeking Alpha's revenue growth, we can see that Amgen is estimated at around 7% or so. Now, being conservative as I always try to be, guys, let's say 6% for the low assumption. Let's go up by 4. So let's say 10% for the median, and let's say 14% for the highest assumption. Now for the projected share buyback, they've been doing around 15% the past 5 years, with a small increase as of 1 year ago. I'm not going to take that into account. I'm going to stick with the normal. So let's say, guys, for the predicted share buyback that they buy back 6%, let's say at around 9%, and let's say at 12%. Doing this, we get the target share prices of $131.97 to $183.22, not adjusting for debt. Now, adjusting for debt, $135 to $186.45, with a margin of safety of 5, 10, and 15. This is between $114.75 to $177.13. Now, obviously, you know, I did buy this company at around $220. The thing is that, well, when I first originally bought this company, guys, I had no concept of discounted free cash flow. I didn't know what shares outstanding was. So, unfortunately for me, it's I definitely overpaid for it, right? I definitely overpaid for it. It is what it is. You know, I'm gonna show transparency as much as possible. Yeah, I messed up. Whoops! It is what it is. Now, my kind of strategy as to where I'm gonna go with this is, seeing that the calculator is telling me at around, or at least the highest, at around like 185 or so, I might now, seeing that it is at 52-week lows, what I might do is dollar cost average into it. If it falls a little bit more, you know, put like $500 at around like 223. If it falls down to like 215, buy a little bit more. If it falls down more, buy a little bit more, like that, right? Just so that way I can lower the cost basis, because it's one of those things that's like, I don't know when it will go back up. So because I don't know when it will go back up, I don't want to be like, oh no, I'm gonna wait till 186, and then it stays at 223, and then next thing you know, it shoots up to like 350, right? So that's not something I want to do. So that's why I want a dollar cost average, even though I overpaid for this company originally. But nonetheless, though, these are my target share prices. Again, you guys can put in your own and see where you land. And by the way, guys, it's perfectly fine to make mistakes. Like, I just made a mistake right here. I just realized it. Whoops. Okay, this is what it is. Now it's time to learn from it and try not to fall into FOMO or even regret as to, you know, making that mistake in the first. So, you know, my way forward to this is just, okay, I'm just going to dollar cost average if it keeps going down. If not, then, you know, so be it. So thank you so much for everybody watching. We really do appreciate it, everybody. If you guys like this kind of content, like, subscribe, comment. It really does help out with the algorithm on YouTube. We really do appreciate it, guys. Thank you so much for everybody that has subscribed since, man, it's just been absolutely crazy. It really has. We do plan on making a lot more shorts as well. We do plan on doing a lot more stuff for the channel, but it's a time crunch. It really is. So it's just, you know, whenever I have time to do something, I try to do it. But if not, then, you know, it is what it is. But again, thank you so much for everybody for subscribing to the channel. If you really do like this content, we really do appreciate it. And the best way that you guys can help us is to, of course, continue doing that, and of course, word of mouth sharing. So taking a look at this dividend, because this dividend is massive, almost 4%, putting in $5,725. This nets to an annual dividends of $218.33. Let's change this now to around, let's change this to around like 195, right? Maybe not exactly for the highest assumption, but let's say at a little bit higher, let's say 195. Guys, if you were to buy this thing at $195, you get $250 for $5,725. So that's really, really good. Like, that's really, really good. And in regards to their, payout ratios, it's still looking solid overall, under the 60% mark, which I like to buy it at. So yeah, from a dividend perspective, this is looking like a pretty decent company. They can afford it, and they're still giving a pretty big yield. So now looking into the options chains, we could see that, this is a major pharmaceutical company, guys. Are going to have a big range of options to choose from. Weekly options, as you guys can see right here. Looking at the May 26th one, we could see that the premiums are looking fairly decent. The calls, though, are looking even better. So it really does depend if you want to sell a covered call on this, if you do have 100 shares. But if you do, you will lose that dividend. Looking at the June 2nd, we can see that the premiums actually kind of remain the same, in my personal opinion. So, it is what it is. But nonetheless, though, here are the options chains when it comes to Amgen. All in all, guys, as I said, I originally bought this company. I did overpay for it, but it is what it is. And me personally, I think that this kind of company right now is heading towards some hard times, but I personally think that they will make it out of these tough days. So that pretty much is it for this episode, everybody. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. Y'all can follow us on the music sites. Link is in the description below. So with that said, peace out, and we'll see you all next time.